This is Dan Dix here reporting for Press for Truth. We're glad to have you joining us today because we got a great show lined up for you, so let's jump right into it. Joining us on the line right now is Lior Gantz of wealthresearchgroup.com. Lior, thanks for joining us, man. I wanted to get you on today to talk about something, well, that we allude to in the title here, the bond Armageddon, because I think this is something that people don't really fully understand the implications of right now. So let me just flat out ask you straight up. We'll start with this. Do you think the current bond market is in one of the biggest bubbles we've ever seen?
I think the most, a bubble is defined by the fact that people don't know that they're in it, right? Mm-hmm. And so the biggest bubble, I think, is the fact that we all are living in a situation where we take the fact that the U.S. Has about $21 trillion worth of debt as a given, because there is no ramification for now, right? But if you and I were inheriting an institution that had $21 trillion worth of debt, we wouldn't be able to sleep at night, right? But the US dollar, or the US as a nation, it's able to run deficits year in, year out, and it's able to monetize it by creating new currency units, which the world absorbs, other countries absorb. And so we haven't seen the real ramifications of this, but we use this debt, or corporations use this, individuals use the debt, students use the debt, credit cards use it, pension funds use it, and we all use it to build tangible things. We buy things with it, we build cities with it, roads, bridges. It's all it has purchasing power. And I think the biggest bubble is to understand that everything that we've built has been, we've lived beyond our means in the Western world because the rest of the world has absorbed this debt. And it will be important to see what will happen when these bonds start defaulting. And I don't mean that the U.S. will default on the coupon payments, on the interest payments. I think that the face value of bonds will be the real problem. So, people think that bonds are safe, right? They fluctuate just a little bit. Their default rates are 2 to 3%, so that's very low. But what you got to really think about is the fact that the face value of the bond and the coupon payments can be eroded by inflation and rising interest rates. So let me just throw a few numbers out there for you, just so you realize how grave the situation is. So we already talked about the $21 trillion worth of debt on the federal level, but the federal deficit is about $730 billion. That's the difference between the collected money from tax revenues and the amount of money that the budget that the president has already signed off on. $730 billion. That's it's a ridiculous amount. And then you got to couple it with the fact that if you divided by every citizen, it's about $65,000 per citizen. Per taxpayer is about $175,000 to repay this debt. That's the entry price to live in America, the true entry price. It's quite amazing if you think about it, because the median income is only $31,000. So the debt to income ratio of an average family, of an average citizen, taxpayer in America is 6 to 1. It takes him 6 full years of work to pay down his debt if he had no other obligation. Mm-hmm. The reason that the United States works is the fact that if you take their total assets, it's worth more than their total future obligation. So in terms of collateral, you still have a situation where the total equity of all the municipalities, the states, the federal level, all the individuals, and all the corporations have about $120 trillion worth of equity, or worth of assets, and that is what keeps America going. The fact that it's a well-oiled capitalist machine. Mostly on the private sector and the public sector. But if you look at the government, it is horrible. It has taken a nation from being the greatest creditor nation about 35 years ago to being the greatest debtor nation in history. And let me explain now why bonds are just insanely risky. And this goes and can be a problem for each listener, whether he holds a bond or not. And the reason is, and I'll explain this, because the biggest bond portfolios are owned by governments, they're owned by sovereign wealth funds, they're owned by pension funds, and they're owned by central banks. So if there's a real problem with the bonds market, there is no one to bail out institutions in the size of nations, right? So here's how you can think about this. When you buy a bond, what you're buying is face value. So let's say you're buying $1 million worth of 10-year treasuries. That's the face value of your bond. If you actually hold the bond in your hands, it has a face value of $1 million. How are bonds priced? They're priced by how much interest payments they're paying. The 10-year bond is paying currently about 2.2% or something. For example, let's take a round number, 2%. So your coupon payments or your interest payments will be about $20,000 a year, right? Now, if the Federal Reserve goes in and does what it promises to do and raises rates 4 times, let's say each time is only a quarter of a basis, is only 25 basis point or a quarter percent. So by the end of 2018, you've now got a situation where the 10-year treasury will probably rise from 2% to about 3%. Nothing hysterical, right? It's only a 1% rise. But in terms of multiplying, that's a 50% or a 1.5 times percentage increase from 2% to 3%, right? That's a 50% rise. So let's think about a new bondholder coming to the market, and now he buys that same bond. It has a face value of $1 million. How much will be his coupon payments? There will be $30,000, right? What happens to the bondholder who bought the 2% yield bond for $1 million? What's the face value of that bond right now? It's certainly not $1 million, because for $1 million I can get $30,000 worth of payments. So what is that $20,000 worth right now? If you think about it, at 3%, it's worth about $660,000. So you bought a bond with a face value of $1 million because it paid you $20,000. But now I can go into the market, pay a face value of about $660,000, and it generates 3%, which is $20,000. So you took a 34% hit on your money. When you go out to the market, you can sell your bond for $660,000. You lost $340,000 in 1% move. So think of central banks, governments, institutions that are in the trillions of dollars owning these bonds, and the Federal Reserve raises rates right now. And I'm not even talking about inflation. We'll get to that. Just the face value of your bonds portfolio can fall by 30 to 40 to 50%. If the Federal Reserve raises rates from 2% to 4%, your bonds face value will fall by 50%, give or take. It's an insane situation, and it happens every time you raise rates. Now, what happens when an entire generation in the US retires right now and is counting on their bonds portfolio to generate either interest payments or equity payments, right? You want to sell your face value, right? And live off retirement. You want to extend your retirement by another decade instead of going back to the workforce. You're saying, let me sell my bonds. Let me sell 200, 300,000 worth of bonds. Well, now if you've taken a 30% hit or a 40% hit, you got to sell other equity. So you sell your stocks and you sell your real estate. And who will buy these things? Who's the buyer in the US right now? Is it the millennial generation? Do you think they can absorb the amount of equity that the baby boomers have accumulated? The baby boomers are the richest, wealthiest, most liquid generation in the world's history. It will depend much upon how much Asian buying will come into the U.S. stock markets and the U.S. real estate market. But at the end of the day, in 20 years, if Asian buying will come into the U.S. real estate market, then you'll have a situation close to Europe where most people are renters because all of the real estate equity is owned by people for generations. They've bought it for cash. They have no problem, holding it. And that's a situation that can happen in the U.S. where the real estate will be cash bought by Asian buyers, and you'll have a situation where most of the U.S. or 70% of the U.S., like in Europe, will be renters, and that's a situation which the U.S. has never faced. So we're seeing a situation where the bonds market is so toxic that if central banks will see their bonds portfolio fall by 30 to 40%, sovereign wealth funds, foreign nations will see that happening. That can even trickle to a geopolitical event, to a situation where it's going to propagate conflict, etc. So, and this is just a face value. I'm sorry. Did you have a question?
Yeah, well, I'm wondering. I mean, it almost seems brilliant, really, by the powers that ought not to be. I mean, is this being done by design, in your opinion? Is this being done on purpose?
Well, that's a great question, because it's the second half of my answer is that central banks have no choice but to raise rates right now, because otherwise the economy is getting very overheated. In the US, there's about 51 million retirees right now, but it's expected in the next decade to be 80 million. So you got 30 million very qualified workers exiting the workforce forever and becoming a dependent demographics on on entitlements, Medicare, Social Security, other benefits, etc. Who is coming in to fill that vacuum, to fill that 30 million shortage in jobs? Well, right now there's about 5.6 million openings in the US, but it will be about 8 million by the end of the year. And for us as employers, as entrepreneurs, to attract employees, we've got to find skilled labor. And skilled labor is not millennials yet. They're not there yet. You can't replace a 50-year-old worker or a 60-year-old worker who has 40 years experience with a guy just fresh out of college. It's not the same quality. And so you've got to raise wages in the US in order to attract the best people to your corporations. And for the first time in decades, we're seeing rising wages. Now, the middle America, what we call Oklahoma, Michigan, Texas, these states that haven't flourished since the 2008 are starting to see the higher GDP levels. Their GDP levels are higher than Florida, New York, and California right now. And so you're seeing middle America flourishing, you're seeing rising wages, and you're seeing a tax cut across the board, which means people have more disposable income, and people save about 2 to 3% in America. So that means that they're going to spend. And if you don't want to see the velocity of money increase, and if you don't want to see 4 to 5% inflation in the U.S. officially, and who knows, judging by the 1980s style inflation measures, which do account for energy and food, who knows what inflation is truly in the U.S., but it's certainly a problem. So interest rates have to go up in order to stop that, in the same way they did in the 70s. But then they were the largest creditor nation. Now they're the largest debtor nation. In that case, the federal government is having a hard time meeting interest payments and meeting new borrowing costs, right? So you're seeing a situation for the first time where the Federal Reserve is trying to tame inflation, while at the same time it's blocking the federal government from doing what it does, which is going to deficit spending and auctioning more treasuries. So this is a conflict between two important institutions. So you're asking me, is this done on purpose? The flip side to this is that inflation goes to about 4 to 5%. CEOs across corporate America say to themselves, okay, what do I do now? Do I fire? Do I hire? My margins are going down. What am I supposed to do? Because I can't plan to the future if I don't know my costs, right? That's the problem with inflation. It's a bitch. It creates a situation where there's a lot of confusion. If institutions and machinery cannot be bought, raw materials are hard to be bought because you don't know how much you're paying. You need to really think. You need to caution yourself. And the stock market hates that. It hates uncertainty. It hates when CEOs say that guidance for next year is unsure. We don't know. How can investors figure out the intrinsic value of companies when they don't know their costs or their future margins, etc. So this is a problem. And many people think that commodities are the origin of general inflation. When I say general inflation, I mean inflation across the board, not just tuition or healthcare or entertainment, just across the board rise of all prices. What really does that is wages and not commodities. Let me explain. Take a $1.50 loaf of bread. And by the way, I'm sorry, I know that I'm giving you a long answer, but I know your crowd is very sophisticated. I just want them to get the full scope. But if you really want like a lengthy report on this, and what to do if you sell your bond portfolio, how do you find other high-yielding instruments or assets, you can go to our site, to wealthresearchgroup.com/bonds, and I wrote an entire report on exactly this situation, what to do in terms of bonds, or on the flip side, how to find 8 to 12% yielding assets that actually thrive in rising interest rates and rising inflation. So going back to what I was talking about, if you take a look at this situation and you take a $1.50 loaf of bread, if the price of wheat doubles, that won't affect the loaf that much, the price of the loaf, because there's only about 7 or 8 cents worth of wheat in a loaf of bread. The rest is the supply chain that takes wheat from the field into the shop that you love to buy your fresh bread at. All that supply chain is built on wages. And it starts with the farmer, and packaging and manufacturing, etc. If these people get a bump in their raise, that actually goes to the bottom line, because you got to pass on your cost into to the consumer. So that is the real problem. It's great for the people to have rising wages, but it's very problematic if you don't have the right interest rates to curb inflation or to tame it. So if you're asking me if they're doing it on purpose, I don't subscribe to the school of thought that says that these are malicious, brilliant people behind the scenes controlling everything. I am more in the school that says that these are your common academics that have no idea what really goes on in the economy, and they're just they're plain old average people, and I think they're doing a lot of mistakes.
Well, they're messing it up for a lot of people in a majorly bad way. And, what is this going to mean? I mean, viewers of this channel have positioned themselves in a great deal into the gold space. And for people with those kind of portfolios, I mean, what can they expect out of this?
Let's talk about what they expected thus far, because that's very important. There's a lot of cynicism and a lot of frustration and desperation in the gold sector, because people expected that QE programs and zero interest rates will lift the price of gold exponentially and will make the miners or the gold juniors, these companies that are very hard to compute their real net worth or their real value, and therefore they go up and down by 400 or 500% up, and then they can go down 50-60% down. And they thought this is a boom period. So for years, people have been holding on to their gold and gold shares in the anticipation that zero interest rates and QE programs are the precursor for great bull markets in the gold space. But the truth of the matter is quite the opposite. 2008 drained the liquidity from the market, and QE programs just restored the liquidity that many companies had or need to have, and many institutions need to have. The QE programs didn't create excess units of currency. They created enough units of currency to fill the void that the credit crunch created, and therefore it didn't trickle to Main Street and didn't create velocity of money and inflation. So what it essentially did is create a society where people don't want to borrow because they're afraid. because zero interest rates means, hey, something's wrong with the economy. So definitely, I'm not gonna hire more people. I'm not gonna expand. I'm not gonna spend on machinery, etc. I'm just gonna hold. So it creates a very deflationary environment, and you feel like you have time, right? Zero interest rates. Why borrow now? Let me borrow in a year. They'll lower it further. So you have time. On the flip side, when they raise interest rates, you're getting into a scarcity mentality. You're saying, okay, next year interest rate is going to be higher. Let me take out that mortgage now. So that's why it creates a more vibrant economy. But when they raise rates, and that creates a better, favorable environment for gold. Now, the best environment for gold is when real interest rates are 0 to negative. And real interest rates is the treasury yields minus inflation. So if there's a 2% inflation and 2% the Fed's funds rate is about 2%, you got zero real interest rates, and that's very favorable for gold. We're entering this kind of period, but we were not in it for many years. For many years, because inflation was very low, we had most of the time positive interest rates, positive real interest rates. So it's important to understand this, and therefore. Gold miners have been very bad investments over the period. Remember, what also computes the price of gold is how much it costs to get it out of the ground, because most miners will not produce it at a loss. So they will hold production, or they would shut down temporarily, etc. And they will not make further acquisitions. So the gold exploration budgets will go down, which has happened. Now, most of the price to get gold out of the ground is oil. And since oil prices have been very favorable for years, then companies could have had no problem producing at about $1,100 to $1,100 per ounce. And so that is part of the reason why the price of gold itself has not risen much higher. If oil prices go up, mining companies will have to raise the price of gold, or they will have to shut down production. Then obviously the market will raise the price of gold. Anyways, throughout this period, the best way to get exposure to gold, because you got to realize, for many people that own gold, they own it for the wrong reason. If they think gold is a safe haven, there is no reason to ever sell safe havens. It's like insurance, right? If you go and rent a car, and they ask you, do you want insurance or not? And you say yes. It's not like you're going to call them 2 days later and you're going to say, okay, you know what? Let me sell my insurance back to you. Let me cancel my policy. It's either you want insurance or you don't. Right. So if you want insurance, own gold. But if you want to profit from the gold sector, the best way to do it, Dan, and we talked about this a lot, you and me, is the royalty model. If you look at the gold sector and you look at what has outperformed all the ETFs and all the managed money and all these brilliant people in offshore environments that create funds for investing in gold, etc., they have underperformed the royalty companies. The royalty companies are just the best business model. In a capital-intensive business like mining, where you have so much capital expenditure before you ever produce 1 ounce of gold from the ground. It takes you about 15 years to build a mine, right? Or if you buy an advanced project in development stage, it takes you 4 to 5 to 6 years. You put cash into it. You don't know what the price will be in 5 to 6 years because you don't control the price of the commodity. And so miners have been a very problematic investment class. On the flip side, if you look at royalty companies, I'll give you an example. The biggest royalty company in the world is called Franco-Nevada. Its market cap is $16 billion. How many employees would you expect a company $16 billion worth to have? Give or take.
Thousands.
30 employees. How can they do that? How can they create this magic, this formula that is working so well? Well, they make upfront payments to either exploration stage, development stage, or close to production companies in exchange for a royalty stream and an agreed upon price from the future ore that will be extracted. I'll give you a scenario. I'm the royalty company, you're the miner. I come to you and I say, how much do you need to raise in order to advance this project into production? You tell me 100 million. I cut you a check for 100 million, and what I do is compute how much ore that mine will have according to your geologist right now. And I create an agreement where I buy the ore, let's say it's silver, for $5 per ounce for the life of the mine. Not all the ore, obviously, because the mining company will need to sell the ore to make money, but a portion of it. And then I flip, the royalty company, flips around and sells it back to the market at $17. So for every ounce that I get from you, I make a $12 margin, banked. Right. It's done. If the price of silver goes above 17, I make more, but I buy it for 5, right? That's how I guarantee, probably guarantee, my revenue here. So these companies can do it all over again. Can do it with 20 or 30 projects. It doesn't matter. All they need is 20 to 30 people that assess deals, sift through deals, look at all the deals, all the deal flow, take all the ones that they want, give them the upfront payment, start gaining the royalties. Franco-Nevada, since its IPO in 2008, which I was lucky enough to buy like a few days after it started trading, has gone up 400% since then in 8 years. Since 1978, when it was launched for $2 million, it has gone to $16 billion. That's a 4,000 time increase in market cap. There's no other mining company in the world that has done that. And it's not just Franco-Nevada. There are other ones as well. Wheaton Precious Metals, formerly Silver Wheaton, Altius Minerals. There's great companies. All of them, most of the time, sell at a premium. It's very hard to find them at attractive levels. Right now, or Royal Gold, for example, if you know that company. But these 4 companies, great companies, most of the time they will trade at a premium. So as an investor, it's very hard to buy them for a discount. And right now, in my opinion, they're about 15 to 20% overvalued for me to increase my positions. Right. So what I was looking for in terms of what to do, I was looking for which sector or which segment or which industry hasn't been royalized yet, right? Hasn't seen that royalty model trickle into it.
Well, that's what I was wondering about. What sort of forward thinking can we do here about other commodities that might work with this royalty model?
Sure. So most people don't treat it as a commodity, but cannabis is a brilliant agricultural commodity, and different from many other commodities right now, it's in a growth mode, right? It's the fastest growing industry in the US. It has a 24-25% year-over-year increase. No other business segment is growing that fast, not even electric cars. So you're looking at the fastest growing industry in the United States. But there's a huge problem, right? The problem is that states are legalizing while the federal government isn't. So to many people, that's a brick wall right there. They don't want to get involved. I'm talking about institutions, funds, Wall Street, banks, etc. So what I tried to find is a company that actually capitalizes on the fact that banks do not enter this space. Because there's a lot of cash-strapped companies. They need to grow. They need to build multi-million-dollar facilities for and warehousing and supply chains and trucking and everything to grow and sell cannabis, either medicinal or recreational. So what I was looking for is which company is, because royalty companies are essentially like banks, right? They make upfront payments in exchange for royalty payments instead of interest payments, but they are similar to banks. So if they're operating in a low competition environment, because banks are not even opening bank accounts for companies, not even let alone originating loans to them. If I can find this kind of company, it has an incredible chance by law, right? By the fact that the federal government has not legalized cannabis yet, it has a clear runway to grow and to create royalty streams without competing with banks on what they want to get in exchange for their funding. And I looked at a company that was private for the duration of 2017, and it just went public in Canada and the US. It's called Fincana Capital Corp. It's a brilliant company, and the reason is two main things. One, it operates in California, but it's incorporated in Canada, so it follows Canadian law, but it operates in the mother of all cannabis markets, California, and its royalty streams are in startup phase, which means they haven't started kicking in yet. And so all the good news, all the positive news that the market will see in June and July once the royalty streams start kicking in is not baked in the cake yet.
Right.
So you can get it at a very attractive, well, personally I'm buying shares right now, but I obviously listeners, readers, etc. should do a lengthy bit of due diligence on this company. And if you want to look at our research, specifically my 91-day research on this company, you can go to thewealthresearchgroup.com/cannabis, and you can download a lengthy PDF report about the company, the management, the royalty streams themselves, my conversation with the CEO over the last few months, etc. I am personally very bullish on this company, with the main focus being that I know royalty works. The upfront, you keep it lean and mean, no overhead, no capital expenditures. They don't touch the cannabis plant. They don't excavate it. They don't try to, they don't try to find the best lighting or the best warehousing and all that. They leave it alone. They bank companies that are top of the line, so they can do what they do, and they get the royalty stream. And what I really love is that they're not only going for the producers. They're also going for software companies that are creating, computing so you can run supply management, and that you can run the medical facility in the right way. So they're diversifying their portfolio within this space to not only be with the producer or the excavators, etc. I love that personally, and the fact is that even within the royalty space, they're the purest royalty company. So even if institutions are looking for, hey, where's the royalty model being applied in the cannabis sector, that company will jump out first to them right now, because they're brand new, under the radar, and it's all in startup phase right now. So they have 3 royalty streams right now, but come the end of it, 2018, they're going to grow and grow. Remember, this is a very low competition environment right now, with banks being out of the picture altogether.
Right. It almost seems like perfect timing, really, because as I understand it, in places like Colorado, Washington, and that they're not even allowed. These dispensaries, for example, are not dealing with the banks whatsoever. So
it's cash only.
Yeah, so and that makes it dangerous and potentially scary for these guys, to be dealing like that. So this is incredible timing, really, for something like this.
It shouldn't exist in a free market society. This type of a competitive advantage shouldn't exist in a free market society, right? Canada should have competition from banks, from lenders, from institutions, but it doesn't. Mm-hmm. That's the big thing about it. It's that federal legalization that's missing to open the field for big tobacco, big pharma, big alcohol. Big alcohol is suffering. Cannabis sales are biting into beer sales and all the alcoholic beverages that people consume, because the millennials love to stay at home and consume cannabis at home. They, instead of going out to the pubs and to the bars, etc., they love their Netflix and staying at home, chatting, inviting other people, socializing. Mm-hmm. And it's different. The world is changing, yet you don't see mergers and acquisitions from big pharma and big tobacco and big alcohol into the space, because it's fairly illegal. It's just an amazing situation. Mm-hmm. And that's why I really am fascinated with what's going on in the cannabis sector.
Now, you mentioned that they're operating or focusing, I should say, on California, but I believe you mentioned something about a relationship with Canada in some sort of way. I mean, what is...
The company is incorporated in Canada, so it's a Canadian company, and it operates as a publicly traded company in the stock exchange in Canada and in the stock exchange in the US, but its business operations are in California.
Okay. Okay. So, but I'm curious because obviously, I mean, things are moving along here in Canada, not as fast as in the American, in the United States, which is sad to say, really. We should have been leading the charge on this.
I think you are.
Yeah. Well, I think it is going to be coming to Canada in a big way. So is this company thinking about the future Canadian market as well?
Well, obviously they're looking at royalty deals in all markets. The California market is unique because it's 39 million just inhabitants of California, right? But there's 250 million visitors a year to California. It's gigantic. It's the biggest cannabis market in the world. Canada overall is about 30 million people. So just the difference in demographics is huge, and the fact that California has a huge amount of retirees or people that are in the cannabis sector for the medicinal purposes, because California has legalized medicinally many years ago. It's a very established market over there already. That's why they went in there first, because the royalty streams in the medical sector are very much efficient and established. And now they want to create other additional royalty streams. But yeah, the management, the CEO is open. From what he told me, he's open to opportunities even in Canada. But right now, with the fact that they don't have any competition in California, or very low competition. I shouldn't say no competition. Obviously, there is competition, but very low competition. They want to explore opportunities there before this window shuts.
Mm-hmm, mm-hmm. It's an amazing opportunity, an amazing space. I mean, could you have imagined yourself 10 years ago that you'd be telling people now to get out of the bonds and be getting into cannabis?
I'll tell you what, it's a unique story because you'll like this. I was invited to Aspen, to Aspen, Colorado, to do some skiing in January of 2013. Just a few months earlier, like 2 or 3 months earlier, Colorado became the first state to legalize the adult use, the recreational. So when I was there was a lot of excitement about this. I went to the first cannabis shops, etc. Did my due diligence on this and realized that people are, they love it. In an institutional level, so the government, they love it because it increases tax revenue, it puts people into jobs, and contrary to what a lot of the stigma about this, there is no raise in the crime levels. There are no junkies on the street. It's all myth. It's a great giant myth about cannabis. It's a plant that people consume if it's recreational. Most people, logical people, middle class women, working class women is the largest demographics right now in Colorado for cannabis. Mm-hmm. These are working class women. They come home, they want to chill with their bottle of wine, so they take a gummy with their bottle of wine, right? It's not like they get stoned and they can't work tomorrow. And on the medicinal side, man, it's the sky's the limit. It cures all kinds of trouble, and the biggest trouble that it cures is lack of sleep. People sleep better when they take medicinal cannabis. But the big thing about it was I was there to ski. Then I ended up doing due diligence on cannabis companies and got involved with the early boom of cannabis companies and made a small fortune with that. And then I walked to this hotel, and there's 3 people, and this is besides the story here, but it's kind of a nice anecdote. And I hear 3 people in the lobby, and they're talking about digital gold. So I approach them and I say, "Hey man, I'll buy you 3 beers. Let me sit down. I want to see what you're doing in your computer." And they show me Bitcoin for $19 back then. I do the research. I talk to them. We sit there for like 4 or 5 hours, and I think I'm a genius. A month later, I'm selling it for 119. So, kind of a nice story, and it just shows you that just being able to network, communicate, be around people, and ask questions is a great way to do due diligence. It reminds me of I don't know if you know this, but American Express had a huge problem in the 60s with before credit cards were their main business. They made loans, etc. There was a whole scenario where somebody cheated them out, and the stock dropped about 40%. And across America, this was like the big story. American Express is involved with this scam or fraud. They weren't the scammers or something. They got scammed, and they lost a lot of money. And it reminds me of Warren Buffett calling merchants in Nebraska, Omaha, and asking them, "Hey, are you still accepting American Express? Hey, are you still, calling actual people?" And everyone said, "Yeah, what's the problem? What's the deal?" "Oh, we don't care about what's going on in the news." "Yeah, we definitely do business with American Express. We love their cars, and they bring the best customers, etc." So he was doing due diligence. And that is what I think people need to understand. If they really want to flourish as investors, if they really want an edge, most people would do a lot better if they stick with private businesses and not the stock market. Most people would do a lot better, because private businesses are far less competitive. If you find a great private business, there's not going to be 10 other investors at the door negotiating with the owner. Yeah. And the other brilliant thing about private equity, private businesses, is the fact that the owner most of the time doesn't know how much his business is worth. If you go to your local pizzeria and you ask him how much is your business worth, he wouldn't know. He's never thought about that question. Mm-hmm. And so it's very easy to negotiate a great price with owners of private, or buy 20% of the pizzeria or whatever at a great price, because the stock market is full of very smart people that's what they do all day long. They evaluate these companies. So if you want to get into the stock market, your best way is in inefficient markets, and cannabis is an inefficient market. Inefficient in a great sense, because inefficient means that it's hard to understand how much companies are worth, and therefore they can be very underpriced at times or very overpriced at other times. And when you look at a company that is just starting to trade and has all of its royalties in startup phase, so they haven't kicked in the revenue yet, it's very hard to understand how much it's worth. So if you can find it where it's undervalued and has all this growth in the future, not banked into the price yet, that's a tremendous opportunity.
Yeah. So yeah, that's awesome.
That's something to look forward to.
Yeah, I mean, I want to do my due diligence at this point, because I don't know if you know that I have a sponsor here at PFT called Liberty Farms, and they are, kind of some of the top producers in BC. So I'm really interested in maybe helping those guys out with maybe getting hooked up with this company. So let me know again the name of the company, and maybe how I can potentially get involved for the sake of my sponsors at Liberty Farms.
Let me throw you a bone. Let me set you up in an interview with the CEO, so your listeners can also check out this in more detail, and you can ask him tough questions and understand how this business even came to be and what they're doing.
I will take it, and believe me, my friends at Liberty Farms, I think, are going to be excited about this, because if it is as you say it is, and you guys are always forward, looking and have been 2 steps ahead and are usually right about this thing, this could be huge for the cannabis market in not only America but Canada too. So
sure. Yeah, I'll definitely make the connection.
Awesome. Well, I'm excited about that, man. We've got some solutions to the bond Armageddon, and they're solutions that fall in direct line with some of the things I'm involved in with some of the people here in British Columbia, and producing what we've come to know as BC Bud. So send me all the information you have. We'll set it up and we'll make it happen. And any links you want to let people know so they can find out how to learn about this from you?
Sure. Well, if people that own bonds or want to know what to do in the future with the bonds portfolio, or how to segue it into high yield companies, I am personally investing in REITs, which are real estate investment trusts that do very well in rising interest rates and in higher inflation rates, because they yield 8 to 12%, and they are in segments of real estate which you and I as individual cannot own. So nursing homes, hospitals, office buildings for the U.S. government. These are REITs that they call them REITs, real estate investment trusts. They're publicly traded, and it's a one-stop. It's one button, and you own a piece of a company that owns dozens and dozens of buildings. And because they work with leverage, they yield about 8 to 12% a year. Great for retirees to offset what could happen with portfolios. With bonds. And so you can go to the research, and I gave out my top 2 companies of high yields in wealthresearchgroup.com/bonds. And if you're interested in more information with regards to Fincana Capital, I took everything that I did, that I researched, all my notes, and just put it together in a very organized manner at wealthresearchgroup.com/cannabis. I know that a few hedge funds have already taken a look at the report and downloaded it, because they took the trouble of emailing me and kind of thanking us for putting everything together and giving them like a benchmark to start their research. So you can definitely go there and check that out. Obviously, as always, wealthresearchgroup.com is a free financial newsletter. I started it 2 years ago when my mind just shifted. I was so intensively involved in managing money for about 20 well-to-do people, like high net worth people. And, I said one day, look, I want to liquidate the fund. We made great money. I want to start talking to a bigger audience, and I want to share my research. And that's how Wealth Research Group came to be.
Yeah, awesome. Well, as soon as I'm done with this interview, I'm going to go check out the wealthresearch.com/cannabis link, because I'm really interested in that, and I look forward to this interview if you can in fact line that up. So once again, man, thank you so much for joining us. Links are going to be located in the description below. You keep up the great work, man. We'll talk to you